So welcome back friends to KYEBYEWAY, where investing is decoded, simplified and maybe even fun. So in just 10 minutes we'll turn confusion into clarity. So let's get started. So friends, today what we're going to do is as I told you in the last video, the first part of PE ratio, the entire series of PE ratio we've divided into three. So the first part we've learned what is profit, kinds of profits, what is earnings per share, what is a lot of things, right? Before I proceed with the second part, I kindly request you to see the first part. I've given the link for the first part in the description below in this video. So please look at the first part and then proceed with the second part, because there is a continuation of the first part. Okay, so today we are going to look at what is ratio. All right, so a ratio is just a way to compare two numbers. It tells us how much of one thing we have in relation with the other. Understood? So for example, if you have two apples and three oranges, the ratio of apples to oranges is 2 is to 3, right? So this means for every two apples, there are three oranges. Simple? Excellent, right? So the picture should help you understand things better, right? So for every two apples, you have three oranges. So that's the ratio, okay? So ratios are useful because they make it easier to understand and compare numbers in different contexts. All right. So let's say a company has a profit of 10 lakhs and 5 lakh shares. The earnings per share, we saw what earnings per share is in the previous video. So that's why I told you kindly finish watching the first video and then continue with the second. Okay. So the earnings per share, or the EPS ratio, would be calculated by dividing the profits by the number of shares. Understood? So in this case, it's 10 lakhs divided by 5 lakhs, which equals to 2 rupees per share. Understood? So the EPS ratio is 2 is to 1, meaning the company makes rupees 2 for every share it has. Pretty simple. So it is extremely important that you understand what is earnings, what is ratio, before we proceed and understand the other complicated things about PE ratio. All right? Excellent. Come, let's see what happens next. So now you may ask me, why is P ratio or sorry, ratio important, right? So ratios are important because they help us understand and compare relationships between numbers very easily. Understood? So they make it simpler to see how one thing measures up against another, giving us quick insight without needing all the other detailed numbers, right? So as simple as when we saw the image of oranges versus apples, we were able to quickly tell the ratio, right? So exactly the reason why ratio is important. So again, let us look at another example. In finance, if we look at the profit to sales ratio of a company, it shows us how much profit is made from each dollar of sales. Got it? So this helps investors quickly understand how efficiently a company is making money from its sales compared to other companies. So it helps you compare between different companies from a same sector, or could be from a different sector, right? So in short, ratios help us make better decisions, providing a snapshot of relationships, whether comparing companies or checking performance or even evaluating costs, right? So as we proceed further, don't worry, things will get a lot more easier. Okay, excellent. So friends, we saw what is price, we saw what is earnings, and we also saw what is ratio, right? So now let's club all the three and see what is price to earnings ratio, or PE ratio. Okay, excellent. So in short, PE ratio is like the price tag of a stock's earnings. This is very important. Kindly make a note of it. Okay, brilliant. So the PE ratio tells you how much investors are willing to pay for each rupee of profit a company makes. So if a company's profit is, let's say, 100 rupees and the PE ratio is 20, it simply means investors are willing to pay rupees 2000 for that 100 rupee profit, which is 20 times the earnings. Simple? Brilliant. So essentially, it gives you an idea of the price tag of for the company's earnings. This is because, I mean, this is the formula, which is nothing but 100 rupee profit into 20 times the PE, which is 2000 rupees. Okay, so a higher PE ratio may indicate that investors expect higher growth in the future, and a lower PE ratio might suggest the company is undervalued or it has lower growth expectations. Okay, but please remember, understanding PE ratio is just one part of the whole investing puzzle. Okay, but this is where we are going to start. All right, brilliant. So this is your formula for PE ratio, which is PE ratio, which is price to earnings ratio, is nothing but price of one share divided by earnings per share. If you use this formula, you'll be able to find out what is PE ratio of a company. Okay, excellent. So friends, let's analyze our previous example that we saw in the first part of PE ratio. Right, so again, I'm reiterating, if you've not seen the first part, the link is there in the description in this particular video. So please have a look at the first part and then come back to the second one. Okay, excellent. So understanding PE ratio. So let's say Trisha wants to buy 10 shares of this company, which is priced at rupees 5,000 per share. Okay. Now she wants to know if this is fairly priced. She wants to know if it is worth paying 5,000 rupees per share. Okay. Excellent. So now how does she find out? One way is PE ratio is equal to price of one share divided by EPS, which is earning per share, right? So in our example, P ratio is 5,000 divided by 250, which is 20 PE. Now again, what is 250? Please watch the first part of the PE ratio video. Okay, great. Now this means that investors are willing to pay 20 rupees for every 1 rupee of earnings that this company is making. Right, now what can Trisha do from this analysis? Now Trisha can go back and now compare P ratio of 20 to other companies in the same industry or the overall market average to see if 5,000 rupees per share is a fair price for this company based on its earnings. Understood? Isn't it simple? This is exactly how one makes use of P ratio to analyze undervalued and overvalued stocks. Okay, excellent. So to sum up, why is P ratio important? The P ratio tells us if a stock is cheap or expensive based on its earnings, number one. In the stock market, if a company has high PE ratio, it means people are paying a lot for each rupee of profit. They might believe that the company will grow a lot and make more money in the future, or the company may be overvalued. Understood? So if a company has low PE, on the other hand, it means people are paying less for each rupee of profit and they might feel the company won't grow as much or could face problems, or it may be undervalued. Right? So now, as I told you before, PE ratio is one of the ways to find out if a company is overvalued or undervalued. Right? So excellent. So with that, friends, we've come to the end of today's module. So if you have any questions, I kindly request you to type your questions in the comment box below, and I will gladly reply as quickly as possible. Okay? So friends, before I let you go, like always, the next video that we are going to see is going to be about PE ratio again, which is the part 3 of PE ratio. Okay? So as I told you during the video, I kindly request you to first watch the first part, second part, and then move on to the third part. Right? Excellent. So I thank you all for your time. Hope you all have a good day and God bless. Jai Hind.